You are listening to Keystone's Stock Talk Show, episode 293.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook, and keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment, and we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
It's great to chat with you again this week, just ahead of our first live webinar series of 2025. April 8th is the last one and nearly sold out. Get it on demand if you are listening to this past the 8th. There are 7 stocks that are on sale that will be presented in that webinar. Okay, I'm going to begin with a small snippet from the webinar defining corrections and bear markets generally, whether the valuations suggest we are facing a correction or a bear, and what to focus on in your portfolio. This week, Aaron will look at last week's announcement on Liberation Day tariffs and how they're impacting your portfolio. In our Your Stock Our Take segment, Brennan begins with a viewer question and update on NowVertical Group Inc., symbol NOW on the TSX Venture, a data analytics and AI solutions company that provides comprehensive software and services to private and public enterprises. The viewer asks if NowVertical is potentially offering up a viable turnaround story with revenues and earnings increasing significantly following recent divestitures. And last but not least, Brett answers a viewer question on Telesat Corp, symbol TSAT, on both the NASDAQ and the TSX, a global satellite operator providing communication services since 1960, which despite a recent pullback is up smartly on the air as satellite companies capture the market's attention. Brett will let you know Telesat's current fundamentals and whether or not the gains are justified. All right, let's get to the show. My co-host, Mr. Aaron Dunn, is back, and we have the Killer Bees, Brett and Brennan. How are you guys doing?
Doing well.
Good to be back. Yes.
How was your vacation across Italy, the rest of the world, wherever the heck you ended up? Iceland, I saw at one point. Do you know
so
where
we did a couple weeks and almost 3 weeks in Italy, and then just a quick stopover in Iceland coming back. But yeah, everything was great. I think that after traveling for 3 weeks, I'm happy to not be living out of a suitcase and get back into some kind of routine for me and my kids. But no, everything was fantastic, and I'd go back again. I'd like to see, we were more around like Rome and Naples. I went to Ischia. I went across to the Adriatic Sea for a couple of days, but I'd like to check out the north and the south and go back sometime. So
yeah, I've been to Rome. It was cool. Great sites, historic, places and monuments. You like Naples though?
Well, I like them both, right? Like exactly like you said, Rome is
diplomatic.
Just it's huge, right?
You don't want to piss off our Rome customers, right? That's what you're saying.
Exactly, yeah, because we have a strong following there. At least since I did my vacation,
of course,
the numbers have increased massively
with a Keystone logo on your back.
It's just it's like everything is so huge and grand. Like it's just it is amazing. I mean, one of the places we're staying, you just look right out the window and there's this ancient monument it's huge, and it's like thousands of years old, right? And it's that's just walking around Rome, right? So getting to see those things is amazing. I like them both. I like Naples. I thought the food in Naples was amazing. Like a lot of cool streets and like back alleyways to walk around but no complaints on either.
I found that was cool about Rome. Like you'd walk modern, turn a corner, and then the Pantheon was sitting there, and you just be like, "Whoa, this is out of nowhere." When I was in Edinburgh in Scotland, like the aesthetic of the city is there. So like, the new buildings are 200 years old, and even when they build something new, you have to keep it. So it didn't have that type of effect. Everything looked old world, right? But Rome has like massive old world amid like everything new around it. It's a different type of city for sure. Very cool though. Although
I've always considered that the big three in Europe to be London, Paris, and Rome, right? And many other
Not
awesome cities
Edinburgh.
too.
I'm just
Edinburgh is incredible. I agree with you.
yeah,
Yeah.
that's cool. I'm just kidding. All right, let's move on. Should we do well, we should say we do have our first webinar, or like the series of the year, coming up. The 8th, you can still get in on that if you're listening to this. It comes out on the 8th, but it'll be on demand as well. So a great webinar, 7 to 8 stocks in this correction to start buying today. So you can get those tickets or get them on demand, and you can view that ASAP. All right. Get to the poll question, I guess, right? We'll do that. Brett, you want to take that away? I think how long was that the holding period, right?
Yeah, the holding period. Yeah, this is Brendan's question for once. Ooh. Yeah, he's finally chipping in there. So the question is, how long is your average stock holding period? 13% of our viewers said less than 1 year, 41% between 1 and 3 years, and 46% said more than 3 years. So majority waited later, which that doesn't surprise me with our audience. So you'll have a lot of traders, obviously, would be the less than 1 year, but then our audience isn't that trader honest. So it's that buy and hold mentality, which is what we do ourselves, of course. So
yeah, I'm heartened to see that it is that, because there is more and more of a mentality to trade in and out, and you know, I mean, even experienced traders. I know some experienced traders that, or at least they think they're experienced traders, that lose money over the long term, and they have all the tools necessary. Been doing it for decades. You know, just for the average investor, you're going to pick. It's more important to pick the quality of the companies that go in your portfolio than to try to trade in and out and you know, have a long-term hold period. You don't hold crap long-term. If the company and the situation goes wrong, you need to get out of that situation. But if you're holding a good company and there happens to be a market downturn like we're seeing now, you can either add more or hold. One of the questions we got in the open segment of the webinar was about you know, what should I do? What is one of the defensive mechanisms? And one of them is, like, if you have a company that yields like 3 to 5 to 10, there's a company we talk about in there at 13.5%, you're going to get paid in a downturn. So you're getting paid far more on an effective basis. Even if it was apples to apples, you'd get paid more without the tax treatment of that dividend in most cases than a GIC right now. You hold that during this period. And if it's a great business, you can even buy more over the long term. You haven't actually made a loss until you sell that company. So, you know, I said in there, the stock market doesn't do this over time. It does this. And if we happen to be in one of these right now, you know, it can be a buying period. Certainly historic uncertainty right now. And we'll get into that in 2 of our first segments.
Mm-hmm. Yeah, I ended up voting more than 3 years, but like I was kind of like saying to Brett, it's kind of tough for my own portfolio. I've only been investing for about 6 years, so realistically, I feel like I could maybe be in between, the more than 3 years and 1 in 3 years. But and like that's one thing that we do as well, is like in the webinars talk about these orphan stock opportunities, and when we're looking at obviously we want to be building our portfolios with, great long-term capital compounders that, you hold forever. But again, we do come across these orphan stock opportunities that we see more of, a near to mid-term, inflection in the business. So, I would definitely
and that can be an element to your portfolio, like an overall 25 stock portfolio for sure. Yeah.
So I'd say that kind of skews mine down a little bit. But yeah, overall,
I think a lot of it to me is also how you interpret the question too, because, we talk a lot about minimum time horizon when you're entering into a stock. We usually refer to that about 1 to 3 years. And what we're saying is, that we're investing in this company because it's executing some type of a strategy, some type of a growth plan, and it will take several quarters for that to come to fruition. And we're expecting that, right? So it's a way of just, moderating or having a base expectation in terms of how long it should take. But if it's a great company that continues to perform, then I say my holding period is indefinitely. I mean, if it can continue to compound capital over time. So, but minimum 1 to 3 years. Ideally with a great company, it will end up being far longer.
Yeah, and that's really allowing the business. Why do we do that? We want to allow the business to be able to grow. Most of the companies that we're talking about would perform to their financials, but you don't hit every quarter out of the park, and then you may hit a quarter out of the park, but you may have all this noise we have right now surrounding the market, and in the near term you get ignored. But if you continue to grow over the long term, and I said this in the webinar, the fundamentals are like gravity. You tend to stick to that over time, and that's what we would expect. Fundamentals of the business, if you see growing cash flow on a per share basis, over the next 3 to 5 years, even if there's all this volatility in the market, the companies you're holding should do well over that period on balance. All right. We probably want to get right into the segment. Okay, so like I said, this week we're presenting our first live webinar series. Today, I'm going to provide a brief snippet from that webinar where we give you 7 to 8 stocks in that segment to buy today while they're on sale. I won't be showing you those 7 to 8 stocks. That's exclusive to the webinar or our clients. Now, with the significant downturn in the markets have produced and are facing, the markets are facing a trade war right now. We define corrections today and bear markets generally, and whether the valuations suggest we are facing a correction or bear, and what to focus on in your portfolio. So what is a correction? In the stock market, a correction is a significant drop in the price of a stock, asset, or entire market, generally defined as a decline of at least 10% from a recent peak, but less than 20%. So a bear market, that is simply defined as a decline of 20% or more. That is considered a bear market, a more severe downturn than a correction. Now, these are traditional definitions, and we're going to stick with them today. But in recent years, markets have been subject to higher volatility than historical norms. We referenced the flash crash following the onset of the pandemic, which produced a 20% plus decline, but a quick and violent bounce back. So not a traditional bear market, but a bear by dropping by more than 20%. It was also a great buying opportunity. We may be seeing an opportunity today, albeit maybe a more drawn out opportunity presenting itself. Now, in a number of markets, we have and are already entered into correction territory, and one we've entered into, one maybe two, a bear market. In this table, we can see each of these markets: the NASDAQ, the S&P 500, Toronto, and I included Bitcoin as well. We are definitely in a correction. The tech-heavy NASDAQ has entered bear territory, driven by the negative move in the Mag 7. And the S&P is close to bear territory, also driven by the outsized influence of Apple, Alphabet, Amazon, Meta, Microsoft, Nvidia, and Tesla. And the TSX just moved into red in terms of correction. Commodities have helped prop up that market a bit, but now they're fading as well. Bitcoin, by strict definition, has entered a bear, but with its historic volatility, a 25% move may not indicate a true bear. Now, most of the highs for this group were made in late February. Declines of this magnitude are rare and shocking, and not seen really since the pandemic's initial shock. Of course, all of these index numbers are what we call price-based. To invest successfully, you need to look at the markets from a value perspective, because, as Warren Buffett famously said, price is what you pay, but value is what you get. So to determine general market valuations from a historical perspective, one metric we utilize is the Shiller PE. It's a more reasonable market valuation indicator than the regular PE because it eliminates fluctuations of the ratio caused by the variation of profit margins during a business cycle. This chart here shows the Shiller over the last 20 years. The ratio reached its highest point in November of 2021 in the range of 38.6, which is roughly 44.56% above the average PE over the last 20 years, which was 26.7. The November 2021 peak was the highest ratio in the past 20 years and has been eclipsed literally once since it's being tracked. That's over 100 years during the dot-com madness, right there at roughly 44. So your question is, where is the Shiller PE today? Well, today the Shiller PE sits at 31.2. The correction to start 2025 has the ratio decreased from 37.8 in November and is down from 35.5 in April, about 1 year ago, and is now 16.1% higher than the recent 20-year average, which again was 26.7 versus 41.5% in November and 34.7 1 year ago. Now, the recent correction has improved the Shiller PE to a better range than the 38.6% hit in November of 2021. Again, that was 42%, roughly higher than the 20-year average. But it is instructive to point out that the Shiller remains 77% above its all-time average of 17.6, indicating the US markets are not nearly historically cheap. On a more positive note, the regular trailing PE following the correction dropped below its 20-year average this past week to 24.2 currently, recent 20-year average being about 24.9. We have not seen that in some time. Now, near term, we are cautious, but opportunities are developing. So let's take a quick look at the regular PE or trailing PE, which is based on the last 12 months earnings on the S&P 500 over the past 20 years. As we can see here, the US market is no longer close to all-time highs, but not near 20-year in terms of valuations, in terms of 20-year or historic lows. In fact, it remains on a valuation basis around average, despite the significant near-term correction. So what is causing this volatility? Well, at this point, it should go without saying, but the uncertainty surrounding a global trade war, Aaron will detail his thoughts in the next segment, is the big influence near term. The outsized influence of the mega cap 7 adds to the volatility. Their influence has become so great that if they get the sniffles, the market gets a cold. 28% of the entire S&P 500 is these 7 stocks. It causes higher volatility generally. We get to some broad market commentary. Heading into 2025, we saw the markets as historically expensive. The markets have only twice been as expensive as they were to start this year, and thus vulnerable to any significant shock. With that backdrop, it is not surprising to see weakness given the significant uncertainty largely surrounding new, more protectionist period potentially. As I stated, in the near term, the markets hate uncertainty, and a trade war creates uncertainty. We are a bit surprised the markets had not corrected further in some names. We saw more of that movement over the past several days. That is not to say there are not some opportunities out there, but are we, for example, aggressively buying auto parts manufacturers or steel makers? No, at present. There are some select opportunities. Like we said, we see value in today. And because our process is to look at, from a fundamental cash flow basis, at every stock in Canada and over 8,000 in the US annually, we have a book of names we are monitoring closely at all times, businesses that we really like, but have not yet bought or perhaps want to buy more of, that in many cases have been too expensive. We await quality businesses dropping to more attractive ranges. We actually released a new buy on one in the past week, a company that was down almost 50% recently, a good company, now trading in a range we want to buy at under 9 times earnings with growth expected this year and into next. Now, most people believe that you get rich in the boom times. We actually see it differently. You actually make your money in the down markets, positioning yourselves in great businesses that come on sale in sympathy with the market. Now, you realize the fruits of your labor or reap the harvest of that portfolio during a bull surge. But it is the work we do during weaker or uncertain economic times that allows investors to profit in the good times. I'll give you an example. From the silly pandemic highs of late 2021, the entire NASDAQ dropped well over 30% by mid-2022. There were excellent buying opportunities at this time. In the 12 to 18 month period until the fall of 2023, we were able to buy high quality, cash rich businesses at a significant discount to the market. Like this drug manufacturer here, Cipher Pharmaceuticals, CPH, on the TSX in August 2023, it held half its market cap in cash, zero debt. It had growth and low valuations. The stock has jumped from $3.75 to over $12 in 18 months. And it still looks relatively reasonably priced. And in a pullback, it could be an opportunity again. While the current trade war certainly has not produced that type of value, there is a list of companies we are monitoring for similar entry points and long-term opportunities. Essentially, great companies that we can enter in with a margin of safety in terms of the discount to intrinsic or fair value. That will allow that you'll not get these valuations and opportunities in these companies in normal economic conditions. This is both on the small cap end of the market, but also right now we're looking in the larger cap segment. Hopefully, we see many of you in our upcoming webinar and we can go over some of those names. Most importantly, our clients will be receiving timely updates on opportunities in the current sell-off in the coming weeks. All right, that is my segment. And because of the volatility in the markets, it has to constantly be updated right now. It's crazy.
Yeah, I had
how
to
volatile
exact same thing with mine shortly before we started recording, and then I just realized it's out of date again. But it's within a couple percent, so
yeah. No, I mean it's just the volatility. I'm sure it has many people scared in their portfolios right now. But we advise our clients, if you started 6 months ago, you're buying into those positions, you're layering in, starting with 25 to 50% positions, and you're buying that 20 to 25 stock portfolio over a 18 to 24 month period. So now you're buying a significant portion of your portfolio when it has come on sale. And there's no perfect way to enter the markets, but even with the uncertainty, it is certainly better valuations that we're seeing today than 30 days ago, than a week ago. But certainly than when we started the year. Now, it may seem more difficult to make those buy decisions when the market is going down, but it is often the most correct decision to make. It's more difficult to hit that buy button when you see markets going down on a daily basis. But if you're looking 3 to 5 years forward, when something comes on sale, even if it goes a little more on sale or significantly more on sale, it is a better time to buy than, say, 2 months ago when it was 40% higher. Okay. Any comments on that, or should we just
I think that it makes perfect sense. A lot of my comments really just come down to what my segment is going to be anyways. But you made a good point. Like there are select opportunities out there where companies with resilient business models are now trading at what we would consider to be very reasonable valuations. But is it really cheap? I mean, there's not blood in the streets yet.
I think that's important to point out. Like we're just not seeing that yet. We're not at that point where you've seen a capitulation or anything like that. And maybe you never have that point. Maybe the market's stabilized. The uncertainty is causing this because you don't know if tariffs are here to stay, if some of them are negotiated off, and that makes it a difficult environment in the near term. You have to focus on businesses that you think will be around and grow 3 to 5 years from now. And that's what we're certainly looking at.
Yeah, and like one thing just to add, because I love Peter Lynch quotes, he says far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. So again, it's just with the amount of uncertainty, who knows what will happen here in the near future. So again, buying those quality businesses that are coming on sale now.
Yeah, and you're looking 3 to 5 years out on those businesses for sure. Okay, Aaron, let's get to your segment.
Let's get about one, which is very related. Day.
Yeah.
Okay, great. So my segment really ties in with your segment, Ryan. We're going to talk about what's causing this volatility and just take a look at what is really on everybody's mind, and that's the tariff and the trade wars. So these are slides that are in our DIY seminar that we're doing right now, where we take a deeper dive into this issue and even talk about different industries that are more or less impacted, as well as other opportunities that can come out of it as well, and areas of risk. But what I want to do is just give a general overview of what's happened over the last week here, because it's obviously the most pressing thing on everybody's mind. So last week, Liberation Day, everybody was waiting for it, but nobody really knew what was going to be announced. Essentially, it was Trump declaring a trade war on the entire world, about 180 countries with baseline tariffs, and then tariffs that went significantly higher than that. Now, Canada and Mexico were left off of this list, but don't be too excited because we are still being tariffed, just not in this round of tariffs. So what he did is he did this big announcement, and he had this list of 180 countries, and an estimate of what he was saying the tariffs are that country is charging the United States. And he said, what we're doing is we're being nice, and we're only charging them half the tariff back. Very, very nice. So this is pages and pages. It goes on and on. But really, when you look at the calculation, the U.S. government calculation of what the tariffs are that the other countries are charging, these are really meaningless figures. So they don't actually represent tariffs. They represent the way they're calculated was by essentially taking the trade deficit with that country. Presumably, it was the actual accurate trade deficit, but taking that and dividing it by the amount of goods traded to get what they can't come up with as an estimated tariff rate. So it's a meaningless figure, but that doesn't really matter. It's basically being applied. So this is obviously been a monumental event in the market. It completely upends the global order of trade, which the United States themselves are the ones that created and have benefited from hugely over the years. Now, as I'd mentioned, Canada and Mexico were not on this particular list, but we still have the tariffs that were previously announced on steel and aluminum, on automobiles, along with everybody else, and then the tariffs on called the fentanyl-related tariffs, which were imposed on 25% of all imports and 10% of oil and gas. So really the only reason we weren't on the list is because we were already tariffed. So the reaction from essentially across the board from everybody is that this is a horrendously stupid thing to do with colossally negative impacts. And we're seeing this in the market right now. So it seems to be the case that most of the world leaders are not quick, at least publicly, to enter into any type of a negotiation with Trump or the U.S. administration. The general sense is that most are preparing to respond with their own tariffs and their own actions, which of course is what escalates into a trade war. And similar commentary from economists, finance people essentially basically in shock. Nobody thinks that this is a good idea. As Bill Ackman, who actually endorsed Donald Trump, said, is that it's creating a self-inflicted economic nuclear winter. So in terms of market downturn, since Trump became president, the S&P 500 is down 16%. Now this changes 2% or so throughout the day. So at one point it was 18%. But regardless, this now puts Trump as having the worst record of any president at this point in time in terms of stock market performance since the S&P was originated in 1957. So how does all of this play out? Obviously, this is a completely I wouldn't say unforeseen occurrence, because this was essentially discussed even when Trump was running. Everybody knew that he liked the whole idea of tariffs. But there's essentially how do investors approach this? How do we look at it? So of the different scenarios, we think of like the scenario that things are quickly and permanently resolved. That is probably an unlikely scenario. Scenario 2, things get significantly worse before improving, but eventually trend somewhere towards normalization. That's somewhat more plausible. And then scenario 3, the relationship continues to deteriorate. So right now, we're somewhat, in some ways, still in the thick of this. And even though we've seen a lot of movement in the stock market, it may not have really started to trickle down onto Main Street and into people's homes and affecting their individual lives. I believe that likely the only way out of this is likely not through countries negotiating with Trump, because I think that there is a lack of confidence, obviously, that he would abide by any terms that he agreed to, since he had already, for example, with the North American Free Trade Agreement, negotiated that during his first term. And that was apparently the greatest deal ever back then. But now that's not good enough, and it's the worst deal. And he's reneging on that. So that makes it very difficult with all the misinformation and the lack of trust to actually enter into agreements. But I would have to think that the most likely scenario out would be pressure on the Trump administration from the inside as things significantly get worse if the United States does indeed go into recession, which one would think would be a very high probability unless things change quickly. So in terms of how bad it would have to be, It really just depends. I mean, there have already been some actions in Congress to try and strip Trump of some of his powers with tariffs. But even if they're able to successfully do that, I think that there's uncertainty is going to persist here for obviously at least a couple of years, even in a best case scenario. Now, as Ryan said, volatility is often considered to be something to avoid. But in many ways, volatility is an investor's best friend if the investor knows how to use it. Now, the first thing, obviously, is when we're talking about what to do in a situation like this is understanding what you already own. And we go through this in the DIY seminar about looking at your current investments. How exposed are they to some of these areas that are most exposed to tariffs or indirect tariffs like macroeconomic downturn? Do you have a good mix of dividend growth stocks, defensive names, and some more growth-oriented names? And are you, most importantly, investing in companies that are highly profitable and solving important problems? And even if those companies experience some difficulties in an economic downturn, those innovative companies are often the ones that will come out in the best shape and in many ways much stronger. Proven businesses with proven business models that have strong financial foundations. So that's the first point, is reviewing what you already own and making sure that you're in a strong position, and then looking for opportunities to add into the volatility. Now, there are already companies that we're identifying that are trading at much more reasonable valuations that they were a year ago, or in some cases in their history. And in many cases, these companies would not be directly or impacted by tariffs due to the way that their supply and their customer chains are set up, or because they have adaptability in that area. So the idea is to slowly add on good quality names in those types of businesses, profitable companies solving important problems. Building a portfolio like that and taking advantage of the volatility. Now, obviously, we don't like to make predictions. There's many ways that things can turn out, but until this is in some way resolved, certainly it's going to be difficult for businesses to make investment decisions, as they won't know on any given day what is being tariffed, what isn't being tariffed, and what they need to account in to their assumptions when making these investment decisions. And if they can't make investment decisions, they can't hire, and the economy doesn't grow. So we're obviously getting more information all the time and looking at a lot of companies and identifying what we think are the best ones positioned in this type of market.
Any comments on that, guys?
Yeah, so there's a couple. I'll actually pull something up about his result, Trump's results. Here's a graph just showing the S&P 500. It has historic results before the S&P as well by president's term, and Trump is significantly worse. So right now I have this is just from macrotrends.net, but Donald Trump, his second term, you can see greatly underperforms Biden's term. His first term, we can bring up Obama, greatly underperforms. If we go all back, this would have been before the S&P 500 was a proper thing, but I assume the website's just doing a back if the S&P 500 existed back then. Great Depression, Herbert Hoover, you can see he even underperforms that. Because I believe in his first term, he said something along the lines of the president should be judged by the stock market performance, something like that, which is, I can't remember the exact quote, so don't quote me on that quote.
Mm-hmm.
Yeah.
But it just shows
we're just looking at the numbers.
Yeah,
that's all we can do.
The point
right?
is how self-inflicted this is. This wasn't some external factor. It wasn't a war. It wasn't a famine internationally, anything like that. This was completely self-inflicted by Trump. And I'll bring something out up now. This is their formula. It looks fancy. It has some Greek symbols in it. It has your epsilon. It has your phi. That must be elaborate. Must be correct. But here's the problem is, so at top you have your trade deficit. That's the X minus M, exports minus imports, divided by the elasticity of demand for imports, and as well as the elasticity for price for imports. So, but the problem is they used 4 and 0.25. What does that come out to? 1. So all they did was took your trade deficit divided by your imports. That's how you came up with those numbers. Mm-hmm. That's how the Trump government came up with the numbers that they did for that left column of what Aaron was showing before. But where they pulled that formula from, and this is from the American Enterprise Institute, it's a public think tank, but what they referenced to get this formula, that elasticity of price should have been 0.945, not 0.25. Big difference there, because almost all that is the passing through the price. So almost 94.5% of the price is passed through to the American consumer on imported goods. But what the Trump, or not Trump himself, obviously he definitely did not do this. Maybe he did. I don't know. Is they did it on the overall retail demand, not on just import products. So that's how you get that quarter. You get your 0.25 from that. So the AEI, they corrected tariffs. What that left column should have been. The most was 13.2%. And the mass majority of companies, as you can see here, or countries, not companies, sorry, are 10%, which was their baseline. The formula they just applied wrong, and as well, it just shows the ridiculousness. And to further really show that point is they even had a line item for the Heard and McDonald Islands, which are uninhabited and have literally just penguins on them. I'm not making this up.
Penguins?
Yes, they tariff penguins. It's an Australian territory, so you think that's just going on Australia, but they just
putting in a wrong input can certainly skew the numbers without massively, right? So yeah.
Oh yeah, no, but the whole point of me just saying the penguin thing is how ridiculous, and I think it's just all done last minute. I don't know anything past that.
Will we now just see, is the plan to just try to negotiate with country to country and think that, I can get a deal with each country? So we'll see. I mean, the problem is it's not just things on a chessboard that you're moving around. This is real people, real situations, and real relationships, and perhaps some relationships get ruined. Maybe they don't, but I mean, you keep pushing and the uncertainty that's been caused here. And then the idea of moving manufacturing back to the US, for an example, many of those manufacturing jobs, there'll be a ton of automation there. If you're building a new Taiwan semiconductor plant in somewhere in the US, that is going to be a massively automated plant. It has to be, because labor would cost too much. I mean, but again, to avoid the tariffs, maybe they can have some labor, but I would think it would be a massively automated facility. So I'm not sure if that's really going to bring the jobs back to the scale that, if you did this 100 years ago, sure. But it's a different time. I'm not sure if there's just going to be a negotiation, but all of this, me saying I'm not sure, is what the market is saying. We're not sure. Thus, we panic and sell. So until you see some normalcy, until you see some level, you never have perfect inputs to model a price of a stock, but you certainly have imperfect inputs right now, far more than average. And that's why it's hard to find a fair value for anything short term. Over the long term, you can see more of a fair value, and that's where we'll find the opportunities. But in the short term, you're going to see volatility. It's just the way it is. Hopefully you're getting paid in many of these companies with dividends, and you're looking long term. Okay. Do we want to move on to, I think it was Brennan next, right? Or did anybody else have any comments?
Move on.
Let's move on. Now what?
Let's do it.
NowVertical, right?
Yeah. Now what? NowVertical. So yeah, I wanted to do a quick update on NowVertical following the company's Q4 2024 financial results posted last week, as a few individuals commented on our last review of the company that Aaron did a couple of months ago. So NowVertical Group Inc., NOW on the TSX Venture, currently trading at a price of about 48 cents per share, about a $45 million market cap, and about 94 million shares outstanding. So NowVertical is a data analytics and AI solutions company that provides comprehensive software and services to private and public enterprises operating within the big data and analytics industry, the company transforms data investments into actionable business solutions. As Aaron previously noted, the stock price has been performing well in late 2024 and now into 2025 as the company's financials have been trending in the right direction. But he stated we should monitor the business over the next few quarters to see if the positive trend in its financials can continue. So let's look at the Q4 results. And here I'm just showing kind of what was driving the stock price. Aaron did this as well when he reviewed it back then. Now, looking at the most recent financial results for Q4 of 2024, ended December 31st of 2024, all of these numbers are in US dollars, so keep that in mind. Revenue shows that it was up 7.6% year over year, but if we exclude the recent divestitures of Allegiant Defense on May 24th, 2024, and Seafront Analytics on December 31st of 2023, Q4 2023 revenue was about 5.6 million, translating to actual year-over-year growth of 94%. So going forward here, I'm just going to be referencing the year-over-year increase if we exclude the divestments here. So gross profit was 5.7 million, growing 37% year over year. Administrative expenses decreased 40% year over year, which is a direct result of management's restructuring effort to become an operator-first model, capitalizing on the expertise existing within the markets to reduce overhead costs and increase efficiency in the business. As such, adjusted EBITDA was up 430% to 2.6 million, and net income increased to 600,000 or about 1 cent per share, up from a loss of 3.9 million or 5 cents per share in Q4 of 2023. So the positive trend in profitability does continue. It's good to see. Looking at the balance sheet, the company has about 4.6 million in cash and short-term investments. Debt and leases were about 15.4 million, providing a net debt position of about 10.8 million. And if we annualize the Q4 2024 results, we get a trailing net debt to EBITDA multiple of about 1 times, which is down from about 1.4 times when Aaron covered the stock on the podcast 2 months ago. So there's certainly some improving profitability there, and debt has came down a little bit. On a valuation basis, I am again going to use the annualized Q4 results for both adjusted EBITDA and earnings. So the business is trading at about 4.1 times forward enterprise value to EBITDA, which compares to the 7 times the last time we covered it. And on an earnings basis, the company is trading at about 13 times annualized earnings. So I would say the business appears reasonably attractive if the company can continue to post strong organic growth numbers. But keep in mind, we are using annualized Q4 results to get these forward multiples, and management doesn't specifically, break out organic results in their MD&A. So that is something that I'm going to mention later here. It would be nice to, kind of get an idea of the trend of organic growth going forward, or what they expect, or what they anticipate. So to conclude here, it is an interesting business in a transition as it divests assets and refocuses operations. There's strong revenue growth historically, and it is transitioning into consistent net profit, or at least it appears to be consistent, and we will continue to monitor that. Insiders have been buying shares in the open market. It's great to see. Management, I believe, pro forma is up to about 27% of shares outstanding. So realistically, I think that it is time to jump on a call with management. They recently brought on Bristol Capital as their investment relations firm, who we have high regard for. So we'll definitely be reaching out to get a call with management. And potential questions I have for management include, like I was saying, do you have a target organic growth rate, a target net income margin? Do you have plans to prioritize debt reduction? Do you plan to slow down debt equity dilution? And of course, just if there's anything else that listeners would like us to ask, feel free, comment them in the comments below this podcast. So, overall, our take, the company is definitely worth continuing to follow closely. The business is showing solid progress. Do I think that it is definitely a 10x stock? Not necessarily, but I do believe the business shows promise and is trending in the right direction. And here is the disclosure. We do not own the stock.
Yeah, and other questions would be, will the organic growth rate continue? Where is it coming from? Is there seasonality to the business? Do you plan to do further equity raises? Like you said, can we limit the dilution here? It's about just under a cent on a quarterly basis. So, is profitability on an earnings basis a goal going forward? That's probably not taxed, right? Like they probably have, I'm guessing there, right? I'm not sure if it's fully taxed there. So again, we have to factor those things in as well to see if there's growth going forward. And, is there going to be, like, what we'd love to see is, yes, this is a seasonally weaker period. We actually expect more strength. We're not affected by tariffs. We're going to generate significant cash flow, paid on debt. We don't need outside financing, and we're going to grow organically. Yeah, it's a perfect scenario. I doubt you're going to get all of those things, but it would be nice to. That are some of the questions that we would ask management just for a brief. We would dig in farther on the business to get a better understanding of all of that. All right. Anything further? Should we go to Brett? I think Telesat. Many questions on global satellite providers. Been a sleepy industry for years, and now suddenly it's back, baby. Apparently, so we'll find out what all the interest is surrounding TSAT or Telesat on the TSX and NASDAQ.
Yeah, and just start that off. I think that really investor hype, I guess, around satellite and space in general really was pushed up by, I guess, Candace's favorite person right now, Elon Musk, just with SpaceX. I think that's really driven the interest behind it. But then, interesting enough, Telesat actually has a relationship with MDA, the other big Canadian space company, which we've had questions about before. So it's actually quite interesting how these satellite companies, quite a few of them have relationships with each other, even though some of them do compete against each other. This isn't the case here, but it's an interesting industry right now. It's definitely changing into the LEO space from what was traditionally the geosynchronous, which is, I think, around 35 times farther away from Earth than the LEOs. So the constellation satellites, and I'll really get into that, why Telesat's actually moving in that direction. So we'll get into that in a minute. But Telesat Corp, symbol TSAT, TSAT on both the TSX and the NASDAQ, is a global satellite operator providing communication services since the 1960s. It actually started as a Canadian Crown corporation, but is now a public company, and it IPO'd in 2021. The company currently has two operating segments. It's geosynchronous Earth orbit business, which is that GEO or GSO. Satellites, which I was mentioning before, 35 times or so farther away from their LEOs, and broadcast and enterprise is their other segment. The big interest, though, in the company, like I was saying before, is their satellite constellation, their low Earth orbit satellite constellation, which they are currently developing, their Telesat Lightspeed. The first Lightspeed satellites are expected to launch in mid-2026, and global service is expected to begin in late 2027. So not existing at this time, but that's really where the valuation, the interest in the company as a whole is coming from. The stock is currently trading at $23.60 and a $1.2 billion market cap. The stock has had great performance over the past year, up 124%, despite the recent pullback in the stock. But like everything right now, it's a volatile market. The price I'm probably saying now has no meaning to when you're listening to this a day from now. Shifting to the financials for 2024, revenue came in at $571 million, down from $704 million. That's due to lower direct-to-home revenue and foreign exchange being a big factor here. Adjusted EBITDA, which removes the impact of that foreign exchange, as well as interest, which they do have a lot of debt, which I'll get into in it. The company had major impacts due to U.S.-denominated debt being repurchased as well. So adjusted EBITDA removes those factors, but that only fell 28% to $384 million from $534 million at a margin of 67% compared to 76% in the prior year. GAAP EPS, it fell actually to negative, and that's due to those factors above, being being the major factors for the difference between adjusted EBITDA and EPS. It fell to $6.29 a share, or a negative $6.29 a share, from an income of $11.29 a share. And they actually had some gains in the last year. Very messy GAAP financials. But the financial decline is expected. It was expected and is expected to continue into 2025 on a top and bottom line basis. Management is guiding revenue between 405 to 425 million, adjusted EBIT between 170 and 109 million, which is impacted by higher LEO expenses of 110 to 120 million. The company expects CapEx of 900 to 1.1 billion. So that upper end is near and even their market cap. And this is what I mean. It's really up for that build out of Telesat Lightspeed. And it's a very expensive project. Clearly, Telesat isn't a company you are buying for this year, this past year, or the next year. It's a company you're really looking to buy 3 years from now, where the value is coming from with Lightspeed. So let's take a look at the company's projected long-term outlook. This is the company's numbers, not mine. As I said before, Lightspeed service isn't expected to begin until late 2027. So we're still over 2 years out before any really income coming back to them from all this massive capital expenditure. So starting in 2028 is where they start their long-term outlook. Revenue is expected to be at 600 million, with growth to 3.2 billion by 2032. That's a CAGR of 52% over this period. So they're expecting very high growth once the Lightspeed constellation gets up and going. EBITDA, or adjusted EBITDA, is expected to be at 400 million in 2028, growing to 2.7 billion in 2032, a CAGR of 61%. Obviously, that will have great margins, as the main costs are being those initial capital expenditures. The company does also expect to start disclosing Lightspeed backlog in Q1 2025, with external analysts, not ours, currently expecting approximately 1 billion in backlog for that initial or backlog in revenue for Lightspeed, so still a couple years out. So how do they get there? They have to fund it somehow. To fund the initial 156 satellites, which is a cost of US dollars 2.8 billion, operational cost of 700 million, and as well as they have a budgeted for a contingency of 300 million for a total US dollar value of 3.8 billion. To fund this, they have already received and will receive some continued government funding. They have total government funding from the government of Canada as well as the government of Quebec for 2.54 billion Canadian, or 1.9 billion US, with the remainder being funded by the company's equity of 1.6 billion. Plus, they have another 300 million in vendor financing. Further, the company is expected to use the internal cash flows once Lightspeed is up and running of 800 million for an additional 42 satellites, which are expected to be in service by the end of 2030, putting that total project capex for the full satellite constellation at $4.6 billion US. And remember, that is 4 times the Canadian dollar market cap. So massive amounts of capex going into this project. So looking at the balance sheet, the company has cash of 552 million, long-term debt of 3.1 billion at this time, resulting in a net debt position of 2.5 million. The company did receive its first funding from the Canadian and Quebec government in January, so that's not appearing on this balance sheet. And the company is looking to continue to restructure its debt. They repurchased some US denominated debt last year. So the cash and debt position will shift, and it will overall shift higher during these next couple of years. The capex spending is massive. Like I said before, their projected capex is 900 million to 1.1 billion dollars just in 2025. So massive capex that's going to mainly be appearing as a debt position. But even if we look at the trailing net debt to EBITDA, the 6.6 times, it's already very high, but their earnings are quite low relative to what they expect in the future. So if things go awry, if there's a big delay for whatever reason, if something significant happens, major setback, it pushes out 1 or 2 years, that can significantly impact the company, because they do have this large, by absolute value, debt load, even if you ignore the relative leverage ratio at this time. So if significant setbacks can actually impact the company's viability, at least on your equity position. So moving to some operational highlights, as it is a very forward-looking company. The company, like I mentioned before, they partner with MDA Space, another public company, as its prime satellite contractor, and they announced in December that the program has successfully completed the spacecraft preliminary design review, which validates the performance capabilities of the satellites, as well as they the company has service contracts or expected agreements to be finalized this year with Viasat, Space Norway, Orange Telecom, and ADM called Telecom for their Lightspeed constellation. So if you start to see those, that adds a bit more validity to the company's long-term forecast when you have these contracts in place, because then you actually can put a higher degree of certainty on them actually hitting those at least revenue targets, assuming things go to plan. But concluding, Telesat is very much wait and see from a fundamental point of view. They have funding for a very capital-intensive project, but now we need to see if they can really build the project on time, on schedule, in budget. And then the next stage after that would be, is the growth profile, is the actual cost and revenue and cost profile aligning with what they say? I wouldn't say they're not making up. They're not. It's in line with their historic revenue and EBITDA margins. So it's not outlandish or anything like we do sometimes see with some of these companies that have no past record, where they just pull numbers out of their ass. But that's not really what I see here. But it's just whether or not they can actually do it on time, do it within budget, or do they need to go deeper into debt? The company does just have loads of debt, but it will be very free cash, and it will be very free cash flow negative until 2028. But then it'll move into very big cash flow positive past that if they can actually hit their targets. And that's really what I would be monitoring for this time, is if they can progress to that stage. But right now, we will just monitor for light speed progression more than anything.
Yeah, I mean, I've seen several of these examples of companies that they really have these super levered balance sheets. They have these grandiose growth strategies that are going to be heavily reliant on issuing shares and debt. And it's like, it's a great story, but that's really all it is at that point in time, is a story. You know, at such time as it turns into more reality, then okay. But 6.6 times, that's already a huge leverage ratio, very, very highly levered. You know, if this were like a cash rich business, it was like, oh, we have this cash, plus we'll take on some debt. Great. But when you're already sitting at a huge, and I recognize that they are expecting a expansion in that EBITDA, which would improve the multiple, but that hasn't happened yet. So, you know, wait and see, as you said.
Exactly.
Yeah. I mean,
it's one of those.
Sorry.
Go ahead.
Yeah.
No, go ahead.
Well, there's just significant volatility in this stock, period. If you look back just to the start of 2022, I mean, it was at $49, you know, right near the start of January. And then, you know, you dropped right down to, by May, 15, and then it had spiked up again to 21. Then it spiked down to, it went down to 9. And then you go to September 2023, 12, then jumped to almost $30, then back right down to $10. Then it spiked up, you know, just since the start of this year from the range of 18. It went as high as, about 36, and now it's, you know, back down to 20. Investors, like, I'm surprised they're looking that far ahead on this. Half the time they can't even look a quarter of ahead when we deal with tons of investors. So you're looking multiple years ahead until they have real significant cash flow. You're going to have declining results, I believe, in the near term, are you not? Like over the next several years.
Yeah.
So like investors' attention spans seem very limited. We wouldn't be surprised, though there is a future outlook that is reasonable and calls for growth at their historic margins. There's a hell of a lot that can happen on the way to getting there. And I think there's still significant risk. Maybe there's a buying opportunity ahead of that. But with the historic volatility, even just in the last 3 years that I'm talking about there, in this market, I wouldn't be surprised to see a significant pullback. I mean, again, that's just guessing, because we can't price it on its current fundamentals. You have to be pricing 3 to 5 years out.
And that's inherently the difficulty with a company like this. So the values we were quoting at late or early 22, that was just right after the IPO too.
Yeah.
And then it got cut into a fifth of what it was really right after that the following year. And it's just because it is speculative. And that's what I really want to get at, is how speculative it is. Even though they do have guidance, even though they do have an outlook, it's still very speculative, especially for the next 3 years.
Yeah, and when we do have existing current fundamentals and growth guidance going forward, you tend to not have this volatility that you're seeing in the share price, because you have something to fall back on. Right now, you know, the cash flow, the real earnings, the reason to be in this story doesn't happen for years. into the future. So that is not surprising to me to see a stock going like this. And, it's not doing this, it's doing this. It's going sideways through this. Having current fundamentals allays some of the risk and you can value it. I don't think anybody can value this. Well, certainly based on current fundamentals. We like to have a mix of current and future. This has future, not really the current fundamentals that would justify buying it right now. So you're certainly adding a layer of risk that's not there in many of the companies that we look at.
It's really that
Hopefully
big
that makes sense.
jump in debt load and capital size. It's just the future project, even though they do have some current fundamentals, it's just on a whole different scale looking forward, which is
for sure.
the difference there.
Okay. Well, I think that ends off our show for this week. If you are watching this right on the 8th, remember we have a webinar, 4 p.m. Eastern, right? Or is it 7 p.m. Eastern, 4 p.m. Pacific? There we go. And it's available on demand if you're looking at this after. Some great commentary on the markets, how to build that simplified 20 to 25 stock portfolio. Look at 7 stocks there. We're also just going to look at, how to find a 10x stock, the orphan stock opportunity, Trump tariffs in your portfolio. So a ton of content and a Q&A at the end. So get a ticket if you can't. I believe it's almost sold out, but there is the on-demand after, so you could always get that. All right. If you're viewing this on YouTube right now, smash that subscribe button. If you're consuming this, listening to it wherever you consume your podcasts, rate and review us. And as always, I'd like to wish you profitable investing. Thank you.
Thank you.
Thanks, everyone.
Thank you.